Hey guys, I was recently asked books on investing, and it got me thinking about um, that and the books I would recommend, which got me thinking about real estate, obviously, which is my favorite form of investing. And then I just got really excited and thought that it would be fun just to do a very informal, very off the cuff kind of walkthrough on just a very kind of introductory just some introductory thoughts into investing and really my case for real estate and why I think it's kind of the best way to go when it comes to investing. So we will do that here. Here's basically what we'll look at. We'll look at why investing is important. We'll talk about why it's important to know your why. We'll talk about the fact that we have to have a strategy with investing in general and obviously with real estate as well. I'd like to make my case for why I think real estate is the best investment. And then we're going to look at two deals at the very end, actual numbers on two actual deals that I've actually done. And I'm happy to show those numbers to you. And that'll be kind of a good, I guess, a good launching launching pad for going forward. Um, the purpose here is, I guess, just to kind of have fun and walk through and discuss this with you and get you guys' feedback and hear your thoughts on investing. I'm happy to hear if you have thoughts on other forms of investing outside of real estate that I might have missed or may not be thinking properly about, or even other thoughts about real estate in particular that we may not be able to cover here. So I'm just going to keep it fairly brief. We'll walk through here fairly quick and we'll try to get to the numbers, which is the good stuff. So, why investing is important. Look, our tax system rewards investment income and it kind of slaps the wrist on the hardworking employees in our country today. So, um, if you consider your return on effort, ROE, if you consider your return on effort for working for someone and really not being able to take deductions on the expenses of your car driving there or the fuel or and possibly having a little office in your house or you really just you can't. I mean, unless you're married or have kids or whatever, if there's no deductions and you're making a paycheck, you're getting a paycheck. I mean, the government really, really, really cuts deep into that. I mean, it really is the working people today, I think, that are paying the, I mean, really, it just seems like the tax system is kind of geared to really cut deep into paychecks. So um, there's lots of tax benefits for investing, and the return on effort for investment income certainly a lot better than return on effort for earned income. And we just need to remember it's not what you make, it's what you keep at the end of the day. I think it's also important to invest just as we prepare for our future. You may plan to never retire, and which is totally cool. But the truth is, you're probably going to at least have more doctor appointments in the future. You may want to take some more time off. You may even want to retire. You may want to do something different with your life. I mean, the truth is, a different day is coming as we all get older. It's important to plan for it, and investing can be a very, very crucial part to that. I think investing is a stewardship principle. So if we just give and spend all the money that we make while we're making earned income, it just seems like very poor stewardship because we could save up some cash for a rainy day, but just putting cash in the bank isn't going to pay you anything. Matter of fact, putting cash in CDs basically pays you nothing either. So it's not very good stewardship just to save up money either, as that being your only way of planning for the future. So investing well is I think an important stewardship principle. Investing gives you freedom and options. So if you do want to change jobs or you do want to do something different or you did want to travel the world or you did want to start your own business or you did want to do, you fill in the blanks, if you have some investments going and they're working, it does give you freedom and it does give you options, and that's always a good place to be. My recommendation is to get to the point and think about it in terms where you're investing your earned income and you're living off your investment income. So think about the money you're making doing what you're doing right now. Uh, many of us or many of you wouldn't really be able to invest all of that right now, which is totally fine, but work towards that. Work towards investing that earned income and then living off your investment income. And it may sound like a very big thing. It may sound like a very difficult feat, but um, an elephant is eaten one bite at a time. So I would just want to challenge you to start thinking if you are interested in investing. Well, then that's a great start to begin with. And I would just say start thinking in these terms here. Um, another way to put this is invest your capital and spend your interest. So invest your earned income and work towards living off your investment income is my recommendation. I think it's important to know our why with investing. It's kind of like with anything that we do. It's important to know our why for many reasons, but here's three, and we won't spend much time on this. But our what shouldn't matter until our why is clear. So let's not get ahead of ourselves and think about how we're going to make some money off investments and how real estate works and how deals could be structured and whatnot. There's plenty of the what to think about, but until our why is clear, that let's not worry about the what. So that's one thing. Another thought is that methodology always burns out if our motivation is unclear. So we can have the best methods around. We can have things down pat. We can have kind of a well-oiled machine, but if our motivation, if our why is unclear, then we're going to experience burnout. With investing, the really good returns tend to be longer term. So being clear on your why helps keep you in the game, and that just stands to reason. I mean, if there was a fantastic investment that you could get back in one day or 1 week or 1 month, I mean, people would be all over that. So yeah, the better investments tend to be the longer term ones, which requires some patience and persistence and dedication. And if we're not clear on our why, then we will probably give up before the good stuff comes. So being clear on our why, I think, is very important. Number three, it's important to have a strategy. We absolutely need to have a plan. And so just to kind of preface here before we talk about these three bullet points that I have here, but I think this one gets overlooked a lot. I think that it's easy to think of in terms of, oh, okay, I want to start investing, and then we just jump into stuff, and we don't realize that certainly the best investors, and really almost all of the investors, uh, they have a plan, they have a strategy, and what's interesting is a lot of times what's right for one is wrong for the other, and it's because their plans are different, their strategies are different. Neither one is necessarily right or wrong. It's just the strategy is different. So one example, not that I guess we're jumping ahead here a little bit, but point number two is you would need to know in your strategy whether you're investing for cash flow or appreciation, and you really should only pick one. And that is something that I've kind of had in the back of my mind for many, many years, really ever since I've started to invest in real estate. I mostly invest for cash flow. I'm trying to think if I've ever done a real estate investment for appreciation, and I have not. I never have actually. So I invest for cash flow. That's why I like to invest in real estate. I'm very aware of that. I'm very intentional about that. It's not a mistake. And I run the numbers out very hard. Make sure that the numbers, I really put the numbers to work and make sure that we're looking at everything. But I invest for cash flow. Now, I'm not saying I would never invest for appreciation, but if I would, it would be very specific, very intentional, and I would know what I'm doing on the front end. So where people really get into trouble is when they think they're investing for cash flow, but really they need appreciation to make it work. Or when people go get a loan and they buy a piece of property and they they plan on the appreciation and then it doesn't happen, and that's going to be a big problem. So there's different um, there's different strategies, there's different risk management types of things that you need to be thinking about whether you're investing for cash flow appreciation. So know whether you're investing for cash flow appreciation in real estate. So important. Pick one. Again, I don't know that either one is necessarily better. I mean, I have my opinions, but it depends on you and your situation and your overall strategy. But you absolutely have to have a plan. I mean, Jim Clayton says a bad plan is more likely to work than no plan at all, and I think he's totally right. So, absolutely have to have a plan. Um, Number three here is look, have a strategy, but do start. Adjusting as you go is better than never starting. So, absolutely have a plan, absolutely have a strategy, but do start. Was talking with someone years ago about real estate, and he was telling me kind of what his thoughts were and what he wanted to do, and uh, and I had the distinct impression. It's asking me kind of what I've done and some of those things, and I just had the distinct impression, kind of leaving that conversation, that what, I think when I see this guy, if I see this guy a couple years from now, um, my assumption would have to be based on what I'm hearing and everything. Like, he was saying he wanted to get into it and he wanted to start or whatnot, but just with the way he was talking about it, it sounded to me like he loved the idea, he loved to talk about it or whatnot, but I was worried that he wouldn't start. And I did see him a couple years later, and he had all these fears and concerns and reasons and all those things, and what do you know it? He had not started. So I think that's a case of over planning. So absolutely have to plan, have a strategy, but you do need to start. All right, my case for real estate. So we'll get into the fun areas here. So look, the challenges with stocks and bonds and mutual funds. Let's start there. Challenges with stocks, bonds, and mutual funds. Uh, they're volatile, they're unpredictable, they have high fees. You can be, well, not can be, you are. You're taxed on gains that could disappear. Uh, they're difficult to understand. You essentially have no control other than basically saying, "Hey, I want to buy or I want to sell." I mean, that's kind of that's and sometimes even that's a little bit can be somewhat limited, but that's the extent of control you have. With stocks, bonds, and mutual funds. So you get to mostly say when you want to buy and when you want to sell, but everything else is really not up to you. Um, Income off of stocks, bonds, mutual funds is largely tied to value. So, I mean, generally speaking, I don't know that people are, you're going to get huge dividends off of stocks, bonds, and mutual funds anyway. Most of it, I think, is kind of an equity play. You put in cash and you're okay with not getting cash kicked back out because you want to see that grow over time. But if you contrast that to real estate, which we'll talk about, you could have your appraised value go down on a piece of real estate and your cash flow be unhindered. It really doesn't make sense, I don't think, to use leverage for stocks, bonds, and mutual funds. In my opinion, it's extremely, extremely risky. And lastly, I mean, I don't even what even is a bond? You know what I mean? I mean, a stock. I understand a stock. You're buying a piece of someone's company. Mutual funds. You're buying many pieces of many companies all lumped together in this one pot, and it's supposed to minimize risk. Um, but I mean, what even is a bond? So I mean, I, I'm an investor. I've invested. I kind of get what a bond is, but my point is this whole thing can be so confusing. It's really kind of up to the professionals, if you will, and common folk like myself. Um, I have invested in stocks and mutual funds, not so much in bonds, um, just because I wanted to learn. And um, I've invested through like investment managers, and I've invested just on E-Trade. just myself, just buying and selling stocks and mutual funds on E-Trade. So I've done both. Recently, the investment manager for mutual funds that I was working with told him my investment strategy really is real estate. And the guy that would be managing mutual funds, if I invested, mutual funds with him, basically said that that's a great strategy. And with what I have in mind, that he would not really recommend mutual funds. I did decide just to take a little bit of money out every month and throw them at mutual funds, which I guess for me is more just of I don't know. I don't know why I'm doing it. Anyhow, I'm not a fan of stocks, bonds, and mutual funds. Uh, I'd much prefer real estate. There are some challenges with startups and Cousin Freddie's business, and generally these types of things are equity plays. So sometimes they work great and you look like a genius, and sometimes it completely fails and you don't get any of your money back. But generally, it's an equity play. There's no cash flow, very unpredictable. You invest in you invest in Cousin Freddie's business, and it doesn't work out, and you lose all your money. It's hard to have a great relationship with Cousin Freddie going forward. But just very kind of unpredictable. But again, this comes back to strategy. So there's lots and lots of people that have made lots and lots and lots and lots of money off of startups, but it's not an area of focus for me right now. So I'm not saying that we shouldn't invest in stocks, bonds, and mutual funds, and I'm not saying you shouldn't invest in startups or other people's businesses. I'm just kind of pointing out some of the mostly cons, I guess, and in an effort to kind of contrast with real estate. So the beauty of real estate, though, is it is stable, predictable, and durable. I mean, it really is. You can look at a multifamily apartment building for years past, and you can somewhat predict how it should perform going into the future. Very durable. If a thing burns down and you have insurance, then you can just build another one. I'm not sure how else you would really destroy it, but very stable, largely predictable, and very durable. Number two, there is a limited supply, and appreciation is common. So with my properties that I own, I bought them for cash flow, but they all have had appreciation, some more than others, of course. But I would say the appreciation in almost every case is more than I would have expected going into the deal. So appreciation is common. But there is a limited supply. I mean, if you think about it, um, there is only so many square miles here. So limited supply, appreciation is common. Number three, you have 100% of the control and the income and the depreciation and the upside with only a portion invested. So with real estate, because it is so stable, predictable, and durable, there is a lot of cases where you can, in many, many cases, you can only put a portion down and you get 100% of the control, the income, the depreciation, the upside, with only having invested a portion of the entire value on the asset. So it's leverage or debt, borrowing, whatever you want to call it. Um, you can have an asset that's $100,000, and you can acquire that asset with, say, putting 20,000 down at 20% or 30,000 down if you need 30% or whatever. But even if you just put 30% down, you would get 100%. You control 100% of that property. You get 100% of the income. You get 100% of the depreciation benefits. You get 100% of the upside, even though you've only invested a portion. So that's a little more difficult to do with stocks and mutual funds. Opportunity limited only by your imagination. I mean, it really is true. There's a lot of opportunity out there. And with the way real estate works, it's mostly what two parties agree to do, and you can pretty well do it. So there's lots of ways to structure deals, and the opportunities, really is limited only by our imagination. Number five that I really like about real estate, and this is really a key one, cash flow is not directly tied to property value. So if you think about, if you have a let's say you have a duplex and it's kicking off a certain amount of cash, and it appraises for X, and then the market drops and the value, the quote unquote value of that duplex goes down. Well, your tenants still owe you the same amount of money every single month. So your cash flow is going to be largely unaffected by the property value. So that's a key one, I think. Number 6, you pay taxes only on taxable net income, if any, if there's any taxable net income after depreciation and all that, and only after depreciation, of course. So um, essentially, you're only paying taxes, and we don't need to get too far into the weeds on taxes, but I mean, essentially, you're only paying taxes on cash that you've received and after you've deducted for depreciation. So you've got cash in your pocket, and then you may owe some taxes, but it's only going to be on taxable net income, and only after depreciation. Contrast that to a mutual fund, where in a year your mutual fund may have a gain, and your mutual fund may have kicked off zero cash, and you would owe tax on that gain in the mutual fund. If you didn't know that already, just stop and think about that for a second, because I mean, it really is significant. In a mutual fund, if you have a gain that year, and hopefully you have a significant gain, that's the whole point, it may not have kicked any cash to you, and you would owe tax on the amount of that gain, but you would have received no cash with which to pay that tax. So Google it for more information, but that's how it works. And you would have less of risk with that with real estate. I'm not sure really in what case you would owe tax in real estate without having received some cash. I mean, there's nuances there, but generally speaking, if you owe tax in real estate, you would have gotten the cash. Number 7, the product demand will never go away. I think as long as we're here on Earth, we're going to have real estate, and we're going to need a place to lay our heads at night. So product demand isn't going away anytime soon. Real estate maximizes the compound effect. So just the effect of earnings over time, managed well, will compound if you keep reinvesting. And it's really because you can have strong cash flow and appreciation with real estate. I mean, you can have both. Now, only invest specifically for one or the other, but you can invest for cash flow like I like to, and you can have appreciation. It absolutely happens. Whereas if you think again about a mutual fund, you can have appreciation, but generally not so much cash flow. So you're kind of picking one or the you're kind of generally only getting one or the other with stocks and mutual funds. And I know there's some little exceptions or whatnot, but in general, with real estate, you can have cash flow and appreciation, those two things working for you. And if you keep reinvesting with your cash flow, it really can have a compound effect. Think about number 9. If you go to the bank for money and you buy some real estate, uh, the bank does share in the downside, but not the upside. So if you go buy a multifamily apartment building and you don't manage it well, or for whatever reason, everything falls apart and you can't make your bank payment and the property value goes down, everything like that. I mean, the bank will get the property, but they don't necessarily. I mean, that's a downside, and they're sharing. They're sharing in the downside. But if that thing appreciates like crazy, and you decide to sell it and just pay the bank off, the bank does not get more. You're going to pay the bank the same where that property value goes up or not. So the bank really does share in the downside, but not on the upside. It puts the investor in a pretty good place. Number 10, real estate's easy to understand and control. I mean, there's a lot that can be learned about real estate. I'm just at the beginning level of learning it all, and there's lots more to learn. But it's relatively easy to get a basic understanding. With just some basic learning on the front end. and control. I mean, if you could be managing the properties yourself, or you could have a property manager. But if you don't like your property manager, you could fire him and get another one. You try to do that with stocks and mutual funds and all that stuff that needs the professionals to handle it for you. It's just a different game. So number 11, the bonus. Look, the people really are great and very open and helpful. It's been my experience. So I think it's just because there's plenty to go around. It's an abundance mentality in real estate, generally speaking, more than a scarcity mentality. And I have no problem showing you numbers on two of my deals, and people have showed me numbers on their deals, and just the community, just in the real estate investment community, it really seems to be a lot of good, friendly, open, helpful people. So I've really enjoyed that. All right, deal review / opportunity awareness. So here's two deals I want to walk through, just so you can see kind of what could be, what can be, and just so you can see some of the opportunities that are out there, and hopefully what your appetite for some real estate investing. Here's deal A and B. So deal A is a property that I bought for $140,000, but only put $35,000 down, and so that's 25%. So for $35,000, I own and control and get to experience 100% of the upside on a $140,000 asset. So hopefully you're tracking so far. By giving someone $35,000, in this case, this math, I got $10,000 back. That's years 1 through 10. That's after paying a property manager, all the maintenance, the utilities, the property taxes, the insurance, the repair bills expected, the snow plowing in the wintertime if you're living in the Northeast or in the North. What else? I mean, that's after paying everything. And the $10,000 net cash, years 1 through 10, is even after paying the monthly loan, the monthly note. Okay, so deal A was owner financed. So after paying all of the expenses, property taxes, everything, property manager, everything, I do absolutely nothing here. And the asset itself, paying the owner its monthly payment, I would net $10,000 a month, years 1 through 10. So that comes at, so again, I've invested only $35,000 in my cash. I've laid out $35,000 in my cash, and I'm getting $10,000 a year back for 10 years. Okay, so years 1 through 10, that would be a 28.57% return on cash. And to get that number, you just simply go $10,000 divided by $35,000, and that's your return on cash. Your cap rate is essentially the value of the property. And, one could argue that, well, we don't need to get too far in the weeds on that, but I'm just using the price I paid for it, $140,000, as the value. I mean, the truth is it's probably worth a little bit more than that. But I did get it for $140,000. I'm just using that math to keep it simple. So if you go $10,000, which is the net that I'm expecting to get years 1 through 10, divided by $140,000 of property value, gets you your 7.14% cap rate. So hopefully you're tracking so far. Now, I have a 10-year loan set up for paying this off via owner financing. So after 10 years, my annual net cash will go up because I'm done paying on the loan. So hopefully you're tracking there. So years 1 through 10, I'll make $10,000 a year. After 10 years, I'll make $20,000 a year forever, because I'm even budgeting in there, routine maintenance and repairs and some of those things. So now at $20,000 a year, that's a 57.14% return on cash. So you go 20,000 divided by 35,000, and or 14.3% cap rate. So fun stuff. Now look at this. Now the depreciation expense here. If you just take standard depreciation, which a lot of times you can accelerate certain things in You can accelerate certain things in the building itself and get more depreciation. But if we just go with a standard 27 and a half years for depreciation, that comes out to being able to expense $5,000 a year. And so if you see there on the screen, I have, quotes around expense because it's not an expense, it's a phantom expense. So again, just to wrap our minds around what is happening here, I was able to give someone $35,000 and they give me back $10,000 a year for 10 years. And after 10 years, they give me $20,000 a year forever. And I'm not even taxed on the $10,000 because of depreciation being $5,000. So now I'm getting $10,000 a year of cash in my pocket, but I'm only being taxed on $5,000 of it because of depreciation. That is amazing, and that's the beauty of real estate. Deal B. Total asset value on this deal was $250,000. On this one, I only put $20,000 down, and that is, yes, 8%, which is very, very low. But it happened. And so net cash here, years 1 through 20, was only $6,000. And so as you can see, the asset value is higher than DOA, but cash in hand is less. But I also put less down. So I was able to acquire a $250,000 asset for $20,000. And then years 1 through 20, after everything's paid, all expenses, property manager, budgeting for the occasional evictions or vacancy or all that, after everything's paid, including the asset itself paying the mortgage or the loan on it, taking all that out, I'll get $6,000 free spending cash in my pocket every year for 20 years. Now, obviously, we should just make a note here that some years it's going to be a little more, some years it might be a little less, but that is a very, very consistent average. That shakes out to be a 30% return on cash. Again, you go $6,000 divided by $20,000 because I only spent $20,000 of my money to make this deal happen. That's a 30% return on cash or a 2.4% cap rate. And then after 20 years, after the asset itself pays off the debt, pays off the loan, that's not cash out of my pocket. That's the asset itself paying off that loan. And if it does take 20 years to pay it off, then I'm netting $25,000 a year for forever. For the rest of my life, and I can will this asset to my kids or my wife or whatever. But and that's 125% return on cash. Because keep in mind, to make this deal happen, it only cost me $20,000 out of my pocket. Or at $25,000 a year net cash flow or net income, and the asset is worth $250,000, that's a 10% cap rate. And generally with my deals with cash flow, been able to get pretty consistently between 8 and 12% cap rates. Now, again, we have this beautiful phantom expense called depreciation. And if you take $250,000, the value of the asset, if it doesn't go up, divided by 27 and a half years, you get to expense $9,000 a year. So look what happens. Look what happens years 1 through 20. I'm getting $6,000 a year cash in my pocket, but I'm operating at a loss because I have a $9,000 a year depreciation expense. So I get $6,000 worth of free cash in my pocket because I'm actually operating at a loss thanks to depreciation. After 20 years, then you would go $25,000 minus $9,000 for depreciation, and you're getting $25,000 in your pocket every year, only paying tax on $16,000. Yeah, $25,000 minus the $9,000 a year for depreciation, $16,000. So That is two deals that I have done. Um, those are actual hard numbers. You may be able to do much better than me. Um, some of my deals have not been this good, but those are two deals that have happened. So just remember, every journey starts with a step. So take your next step. Might be reading up on real estate investing. It might be grabbing coffee with someone and asking them. It might be talking to a property manager, whatever it is. But every journey starts with a step. So take yours. Um, I can be contacted on Twitter at Kent Lapp or on my website at kentlap.com. There's really nothing in this for me. I just really love uh, real estate and investing in general. And when someone asked me for books recently to recommend for investing, it just got me so excited and got my mind going. And I just kind of just thought it'd be fun to kind of walk through this and maybe possibly add value to someone. I will say, if there's only one book that I would recommend to start with next, would be Rich Dad Poor Dad by Robert Kiyosaki. Rich Dad Poor Dad by Robert Kiyosaki. Go read it. It will absolutely change your life when it comes to investing. I've read it a couple of times and probably should go ahead and read it again. So that's it. I'd love to hear from you if this was helpful or not helpful, if you disagree with anything or find any mistakes or anything like that. I'd love to hear from you. Otherwise, good luck with your investments.